Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, welcome. This is the Investor Coaching Show, pre-Christmas Investor Coaching Show.
Yes.
We got Christmas bumper stuff.
Oh, good.
I'm asking.
Oh.
I'm asking. I don't know. I'm not in charge of that. I only look like I'm running anything.
In the land of the blind, the one-eyed man is king.
That's right, baby. And I am totally one-eyed king. Hopefully we do. We'll see. I don't know. We'll see how it goes. Yeah. Fun stuff. Man, how you doing? Evan Barnard here with me. We hadn't really talked too much before we started. We just kind of get here and sit in front of the mics and go.
Just crashing the party. That's right.
I know. I love it.
Yeah, actually, it's going well.
Already, do you, like Christmas Chopper, Cindy, do all that stuff?
That would be a Cindy task.
There you go.
I just write checks. I mean, literally.
Man after my own heart.
Well, of course, both boys are married and so forth, and anymore, it's just easier to send them a check for Christmas and they can get what they want ahead of time, and whether they use it for a trip or use it for a something. And then that's my game plan. Mm-hmm. And then Cindy still takes about 3 months and finds little things to put in a box and mail out to Washington or Florida or wherever they're at.
Oh, yeah. I suppose that's practical. All right. I guess we get practical as we get older. So what?
Yeah.
Oh, man. Yeah, so fun. Just fun stuff. I enjoy this time of year. I enjoy the drives home at night and watching how everybody decorates their houses.
It's interesting you bring that up. And, it's a little bit like music. And, you being a musician, hopefully this will resonate, but music does tend to kind of reflect the economy. And I think Christmas lights have sort of taken on that characteristic this year, because we kind of live out in the sticks, and
that's interesting.
A lot of people have decorated this year.
Yeah.
I mean, it's significantly more than normal. It's really been fun to see.
Well, as I saw something about Christmas music making a huge comeback.
Okay, yeah. Makes sense.
That is, I guess people are, feeling pretty decent. And I was on Channel 5 this week. And Ben goes, is it just me, or does it feel like everything has been up and down all year long? And I said, well, I said, it depends on what you listen to.
Yeah.
When you listen to what the media is reporting and who's talking about what's going on, a lot of this year has been actually fairly decent in a lot of different ways.
Yes.
There have been a lot of really positive things that have happened this year. And I said, and if you look at, what has caused the productivity increases, and I said, you look at oil prices. I saw somebody had made a post, filling up their tank and going, Merry Christmas to me. and just kind of excited about, what's been happening there. And I think, just jobs data, everybody said AI was just going to kill jobs. And it's just been flat, which is actually okay when you have a lot of people that are worried about losing their jobs, but there hasn't been that necessarily as much as it's just been flat. You don't have job losses. It's just new jobs that are coming on are displacing anything that might be going away. But, that has been fairly decent data coming through there. Inflation data has been coming through fairly decent.
Yes.
Which is a big deal.
Under control. That's maybe an overstatement, but
yeah,
certainly much tamer than it was a couple 3 years ago. And just thinking about employment and not, I don't want to swerve into the political side of the fence here, but they talk about investing, so we can talk about economics. But
yeah,
an interesting stat that I heard this week, and I think it was on CNBC, was American jobs have increased by 3.5 million people, none of which were government.
Yes.
public sector.
Yeah, I have
And-
heard that.
And as a function, I think, of some of the self-deportation and so forth, the closing of the border, more Americans are working than had been in prior years. And to me, that was really encouraging.
And, so what Ben was asking about, he says, well, it seems like everything's been up and down. And I said, well, yeah, from a standpoint, there are winners and losers and everything.
Sure.
I mean, anytime that you have new technology, there's creative destruction, as we call it in economics. But from a market standpoint, if you look at large U.S. companies from the date when I was doing that interview, it was up 14%. The S&P was. And I said, other areas of the market up much greater that you wouldn't think about. And we talked about international markets being up 40%. I mean, it's just
Still.
yeah. I mean, it is. It's huge. So, those market segments, and my wife sent me something this morning. Deb sent me something saying that emerging markets have been rocking. And I was like, I was so childish.
What
I
must
said,
your
"Nah,
dinner
nah, nah, boo-boo."
conversations
Most
be
people
like?
don't know that stuff. I was just so childish. That was very un-Christmas like. But seriously, I mean, it's just the whole thing about diversification.
Yeah.
I have something on that today, as a matter of fact, and I'll talk a little bit about it in a second. But it was just that whole idea of, I can scream at the top of my lungs, diversify, diversify, diversify. And people just go, I have to be diversified. I'm with a huge mutual fund company, and they wouldn't possibly not be following the rules of investing.
Right. Yeah.
And I'm like, no, they aren't. How do I get you to wake up and hear this? But, they aren't. But there was an article, it was entitled, Do You Really Know What's Inside Your 401k? And it was that particular. So I'll talk a little bit about that. But there was another article that I thought was interesting, which was with the S&P 500. And it was how certain companies with the tech rally going on. The tech rally has not been helping, or the lack of tech rally, I should say, the tech, backing down has made it just darn near impossible for American investors who are very, very focused on S&P 500 type companies to be doing well. And they've been really struggling as a result of that. And it was as the stock market rally broadens was the title of the article. This is from MarketWatch. It's tough for the S&P 500 to keep advancing without tech. And they were walking through, it was a really, really interesting chart. And I'll try to do my best to explain it to you out there listening, what it looks like. But it was communication services, healthcare, both, up really, really good. Consumer discretionary, financials, not quite as much, but not bad. Consumer staples. And then it was showing the S&P over this period of this particular was since October 8th. For some reason, they chose October 8th because this is when this turnaround started happening. Then what they do is the second half of the chart, you start to see negative returns. So you see 6.2% return for communication services, 6.2% for healthcare. Consumer discretionary is 3% return, and financials 1.7%, and staples 1.6%, and the S&P is up 0.3%. 0.3. Then you go, well, why is it only up 0.3? It's because materials are down, negative. Industrials down, negative. Energy down, negative. Real estate down, negative 2.3. Technology down 3.3. Utilities down 5.4. So it's saying literally all of the stuff that was super, and technology in particular, down 3.3%. Significantly, a big part of the S&P 500 has just been, it's taken it on the chin. So they basically found that, that if you look at what's been happening, it illustrates how hard it is for the market to make headway without technology participating because of that. And it says this one person they're interviewing says, well, we push back on bubble analogies. We push back on that. Between the current AI boom and the dot-com era in the late 1990s that ended with a bust, and, it's a lady, Marcy McGregor, head of Chief Investment Office's portfolio strategy at Bank of America's Private Bank and Merrill Lynch Wealth Management, in a phone interview and of course, we're pushing back on this idea. They're saying that, with the AI boom, the market is really pushing back at times, showing some degree of skepticism to McGregor's thinking, makes a current enthusiasm distinct from the euphoria. This is different now, than what we were seeing in the late 90s. And there may be some differences, no question. History repeats, but it doesn't rhyme. It doesn't repeat, but it rhymes, right?
Yeah.
But they're saying that this, and then they had this other person from State Street says, we don't think it's a bubble. Even if it maybe have a couple hiccups along the way, said in a phone interview, we have high conviction in technology. Now, Evan, if somebody has high conviction, what does that tell me about their investing strategy? What are they doing?
Well, they are market timing and most likely stock picking as well. And frankly, chasing performance. I mean, they're batting 3 for 3.
And feeling good about it, though. Because they have high conviction that it's the right thing to do.
I'm confident that I'm right in predicting the future.
Right, exactly. And that's what hit me. And it says the bull market's been running for 3 years now. And this reminded me of something that Ben said on the Channel 5 thing. He said, it's been running for 3 years. It just feels like it ought to back off and it ought to go down. And I said, well, you got a 1 in 4 shot that you're right. That's the way it works. You got a 1 in 4 shot that you're right, that it's over, and then the markets go down. And I see, so technically it can. Yeah, but, at any point in time, that's all you've got is you have a 1 in 4 shot that markets go down. You got a 3 in 4 shot that they go up. And I want to be on the side of higher percentages.
Yeah. Let the math work. I mean, casinos don't build buildings because they don't understand probability.
No, that's exactly right. And so, you hear these investment managers, and, I've gotten to the point where, you and Evan and I have talked about, do I mention the name of this company? you and I have said that before.
Yeah.
And I'm at the point, I'm going to mention it because people believe. And I remember, I'll never forget when you did Navigating the Fog of Investing. Remember that theater?
Yeah. Yeah.
That you actually had that in.
Oh, down in Franklin.
When you first, got to, it was fairly close to when you first got to Tennessee. You said, hey, let's.
9 or 10, yeah.
Mm-hmm. And I'll never forget, when that movie was over, and they were all people that had not all people, but a lot of people that had no experience working with us or hadn't actually physically talked to us or had us look at their investment portfolio. Mm-hmm. And I was telling a friend of mine just now, I says, we physically have to look at a portfolio. And here's why I have to look at it. Because you will not believe the stuff that we're talking about is happening to you.
Yeah, yeah.
And I will never forget, there was a lady at the end of the documentary. And I walked up to her, I talked to her afterwards. And she said to me, she goes, yeah, wow. Yeah, that was crazy stuff. She says, I'm just glad my advisor's not doing that. I was like, your advisor is doing that.
Hopefully she wasn't a client yet.
No, she wasn't. No, I didn't yell at her. I'm very nice.
No, I meant that her advisor wasn't doing that.
That wasn't you.
Me.
No, it wasn't you. No, it was not. That's hilarious.
We ought to play that again sometime. We have to do that.
Navigating?
Yeah.
It is really good.
It's a little bit dated, but
on the principles.
So is Christmas service and Easter service. I mean, you know how it turns out, but it's still important to be reminded of these things.
It's really funny you say that it's dated, and I think back to writing the Above the Maddening Crowd.
Yeah, yeah.
And writing that.
That would be Paul's first book for you new listeners.
And writing it and having just the bad fortune of finishing it using the year-end 2007 data.
Yeah.
Just before, like, the biggest market downturn since, is 70s, maybe? I think maybe we could say.
Yes.
Yeah.
70s or 29, either one.
Yeah, probably 29. You're probably right. It was probably back in the Depression. I mean, we had the biggest market downturn. And, I rewrote I've written it several times to re-update the data. Not really a total rewrite, but, a decent one. But the beauty is it just never had to redo the data or anything but the data, excuse me.
Yeah.
The principles. So your point about, navigating the fog of investing and it being very current as far as what's in there.
Same stuff goes on.
But this is it. And this is kind of the way I want to end the segment, is just talk about what is it? Why is it that this stuff doesn't have to, this message for 25 years on the show, I haven't had to change. We haven't had to change much at all. And it's based on the idea of market efficiency has been a big deal on this show from day one. Adam Smith, Wealth of Nations, wrote a book about how markets work. There were some people that were smart enough to take what he wrote and say, hey, you know what? Maybe we ought to build an economy based on this idea. Maybe we ought to build a nation. And that was the Wealth of Nations. What is it that we could do that would make America a success story? Because this is written in the 1700s, 1790s. What could we do? Here's what we could do. We could have the government back out. We could have the government exert less control. We could have the government not set prices. We could have the government not try to determine what products that the public might demand. We could do something that would be different than anything that has ever been done before. We could, let the market set prices as far as what they should be paying for goods and services. We could have this thing called the invisible hand, he called it, that actually, it's just the sum total of all of our the supply of labor, the demand for labor, the demand for products and services, the tastes of people that are buying things. We could let that dictate what prices should be rather than some boardroom of really smart people that tell us that, hey, you know what? We have strong conviction.
Buggy whips are the wave of the future.
Yeah, we could do that. And we can build an economy better than anybody has ever seen in the history of Earth. And by George, he was right.
They did it.
And this is why when you listen to the academics that we quote here on this show, they will tell you that communism, socialism only exist. Now, despite what your liberal friends say, that socialism is what they use in Sweden, Norway, and Denmark, it is not. They will tell you adamantly that socialism is not what they're practicing in those countries. No, it is what they tried in the 70s and 80s, much to the chagrin of the populace, because they suffered greatly. But what they did is they actually exercised capitalism. But anyway, they said, the academics would say, socialism, communism, we see it in North Korea, we see it in Cuba, and we see it in active management of investment portfolios. And the problem that most investors, the problem that they have is they don't realize, it's kind of like if you grew up in Russia, and you grew up walking into grocery stores that were empty all the time.
One kind of bread.
That was normal.
If they had it, right.
That was normal.
Yeah.
And you come to America and you go, I love America. What's that guy? I forget the Russian guy.
Yakov Smirnoff.
Yeah, Smirnoff, right? What did he say?
What a country.
What a country. Thank you. No, totally. Thank you. The memory department here, Evan, is my memory department. Yeah. So, what a country. If you never came to America to see our grocery stores, you wouldn't know that that's what you should experience.
Correct.
Because investors never benchmark their portfolios, they don't know what should be happening. And I think that is the problem. And that's what this show is all about.
Yeah.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, there are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic. Number one, Number 2, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, they're hooking us up here, Evan. Us old guys with a more traditional.
I'm picturing the scene in Home Alone where he's dancing to this song.
Oh,
to
is he?
Keep the crooks from coming in the house or something.
Oh, man. I hadn't seen that movie in forever. And yes, I did see it. Aren't you impressed?
I am.
It was kind of a goofy movie.
Launched a career.
I guess. For who?
Macaulay Culkin.
Oh, is that what launched his career?
I think so.
Okay. All right.
His brother was in that.
I'll
for
believe
whatever
you.
reason, that never
I'll believe you.
took off.
Insurance rates should fall next year. People ought to be happy about that. There haven't been all of the disasters that we've had in previous, not as many disasters as we've had in previous years. I guess wildfires may be down a little bit. Severe thunderstorms may be down a little bit.
Hurricanes down.
Yeah, they were worried. They were worried that they're going to lower the rates too much. I don't think you can worry about that. I think, isn't that funny about the media? It's like, oh my gosh, something good is happening. Well, I'm worried that it's not going to be, that they're going to undercharge.
They're going to swamp our phone line saying the rates are too low. Please raise my rates.
That is just so the media. That's just the research.
Is. Fear sells.
Yeah, what's the research on media reporting? If it's really positive information, nobody engages.
Right.
If it's negative information, you got a great engagement. And if it's, in the middle information, there's just kind of in the middle engagement.
Yep.
But it's just so funny how we as humans just go for negative. And it's like, why do we do that? Well, I've got something I can protect myself against. Mm-hmm. If I have something negative, I know what the enemy is. I know what I have to protect myself against. So reporting on negative things gets our attention. If it's positive, I don't have to do anything. All's good.
Right.
It's just kind of how this stuff works. But it's the reinsurance that they're actually looking at. The reinsurance rates are set to drop sharply in 2026. And I thought it was just interesting, what they're actually doing has to do with, they said car insurers have been aiming at lower rates to grab market share. And it just reminded me so much of a conversation that I had with a car insurance guy, an exec. Mm-hmm. I came in here, I was working with him on his financial planning stuff. And I looked at him, I said, so you're an actuary, for that does this type of work with car insurance and homeowners insurance.
Yeah.
And I said, how do you guys set prices? And I thought it was going to be a really nerdy conversation.
Yeah.
And he goes, we just look at the competition. We just charge a little bit less when we want to build more new business. We just look at what they're charging and we just undercut them. And I says, you don't look at like claims or no.
Was he serious?
He was serious. He was totally. I thought it was the funniest conversation. And it's just like, yeah, it is. And the reason I'm bringing this up is that if you have auto insurance or homeowners insurance, which you probably do if you are a driver or if you own a home or if you got
Follow
renter's
the
insurance,
law, anything crazy.
If you don't want to, just throw caution to the wind. It's interesting because in the old days when I sold insurance, in the deep dark days, as I kiddingly call them, 30 years ago, it behooved you to stay with the same insurance company for a long period of time because you got benefits for loyalty.
Yeah.
And the reality of it is that, and I got this from Consumer Reports themselves. They actually did a ton of research on this, but they said those days are gone. And I thought that was interesting.
I agree. I mean, my agent even, this is now years ago, and he had switched companies. And, some firms try to price to buy the business, and then they just raise your rates fairly quickly. So you really do have to, shop it every few years, and you want to make sure you're comparing apples to apples, right? You don't want to change coverage necessarily.
Very, very true. And, for the average person to do that, it's hard to do, but there are certain things. As a matter of fact, my book on financial planning, I talk about a little of the stuff that I think that you ought to be looking for.
Yeah.
Home, liability insurance and liability limits and things like that. But yeah.
Well, talking about rates even and paying attention to rates, the fact that you can't just assume you're going to stay with the company long term. I was speaking with someone last week, former service member as I am, and we were talking about USAA.
Mm-hmm. Yes.
And we were talking about the fact that their insurance rates have just become way less competitive than they used to be in the past.
Are they still doing dividends for you, though? Because,
they are.
All right. And even after dividends, they're still less competitive.
Yeah.
Interesting.
And we were talking about it. And so some of it, I think, has to do with the risk pool, which could affect other companies, too. But originally, USAA was for officers only.
That's right.
And then, added enlisted and then added families and so forth. And as you broaden that much more diverse risk pool of education levels, skill levels, all that kind of stuff.
Sure.
It changed the pricing.
And you have moral hazards.
They're now the same group of people that's got State Farm or Geico or Progressive or whoever.
That's so interesting. Yeah, because so often we talk about your credit score. Yeah. And people say, well, a credit score doesn't matter because I don't borrow any money. And I'm like, no, your insurance rates can be based on it because you don't have the insurance companies don't have a whole lot to go on for character. Mm-hmm. Does this person do they pay their bills on time? Are they somebody that's likely to defraud an insurance company? So therefore, they'll look at the insurance company will look at your credit score and say, okay, if this person has a high credit score, they probably have character. They have character in one area. They'll probably have character in another area. And what you're saying, which makes total sense to me, Evan, is that if you have an officer to get to that level, you probably are a person of fairly, this isn't universal because you'll have people that are of low character.
You're responsible.
Irresponsible that reach those levels in the military. But in general, they tend to be fairly responsible people, and therefore you could charge them lower rates. And now that the masses are more in these companies, you don't have the advantages anymore. That makes a whole lot of sense to me. So I remember when I sold auto insurance, homeowners insurance. Now, my parents are both gone, so I can tell this story. But, what happened was I was trying to get Dad. I said, Dad, I was working for a huge insurance company. I said, Dad, I want to quote your auto insurance and your homeowner's insurance. He goes, okay, Paul, yeah, go ahead. And so I quoted it. And I come back and I said, so what are you paying? He tells me what he's paying. And I said, well, look, I can get it for you for this. Oh, okay. And I was like, well, Dad, don't you want to do this? And he'll, yeah, okay, I'll think about it. And then he pulls me aside later and he goes, don't tell your mother this. But the dividend I'm getting from USAA is enough that it's actually still way cheaper than you.
Yeah.
And actually he was an officer. But, it was kind of funny. It was, I learned, I don't know what lesson I learned. It wasn't to keep stuff from Mama. Oh, I knew I was taking a risk when I told that story, but
hey.
But anyway, so
just don't look under the bed, honey.
That's right. So anyway, so that from the auto show, and just keep in mind, it's something you can look at and shop every once in a while because the old days are different. It's a different deal than it used to be. Okay. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor.
Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.